Well, I think the market actually thinks that OPEC is going to continue with its plan to increase its production quotas by 432,000 barrels per day each month from now through September, which would add a quota total of 1.7 million barrels a day. The problem is that OPEC Plus has failed to reach those production targets, and the shortfall now is about 1.5 million barrels a day.
So I kind of have a silly question because OPEC represents people who drill and sell for oil. Isn't it in their interest to have the oil prices as high as possible?
Well, I think it is, and I think that when you hear OPEC Plus really push their decisions back by blaming the uncertainties in the demand destruction in China due to COVID or the uncertainties on Russian oil production, they're taking the path of least resistance, which is to continue with their existing agreement and then watch prices really be high enough to replenish their coffers, which were depleted during the pandemic in 2020.
The markets are in a near panic over inflation. We saw the headlines yesterday from the Fed. We're concerned about oil prices. We're concerned about, look, oil prices are up like 50, 60, 70%. Plane ticket prices are up 80, 90%. And food supplies in the U.S. and around the world, you know, they have to be moved around. And the price of gas is very important. Where do you see gas, say, by the end of summer?
Well, I think right now we're headed towards $4.40 a gallon as a national average. That's up about 15 cents a gallon from today. And I think it could move higher, especially as we see the European Union or its member countries phase in an oil ban from Russia. To put this in perspective, Europe is importing about 4 million barrels a day of both crude oil and refined products. Well, if you add the United States and UK bans of another 700,000, you can see that the world is looking for upwards of 5 million barrels a day of alternative supplies. And since those supplies are really not forthcoming in the short term, the only way to get us back in balance is through demand destruction, which means higher prices.
Well, or a recession. Earlier, President Biden, who was talking about this, you know, announced the release of, you know, a historically large amount from the reserves. It helped, it seemed like for a week, and then we've all kind of forgotten about it. Is there more the White House can do?
Well, any release of strategic petroleum reserves just buys the world some time. But the issue is, how do you get more oil out of the ground faster to replace any Russian oil? There's very little that the administration can do in the short term other than suspend the federal excise tax of 18 cents a gallon on gasoline and 24 cents a gallon on diesel to relieve the customer of some amount of pain, but they've been very reluctant to do that.
In Washington State, where we have one of the highest gas taxes in the country, we're at $5 a gallon. In California, you're in the low to mid sixes already in terms of gasoline. You talked about demand destruction earlier. At what price does the consumer, I suppose, start walking or just not driving? Is it $7 a gallon? Is it $8 a gallon?
Well, we haven't really seen that much demand destruction in California, where the state income level is generally higher than in most other places of the country. I would say on a national average, you've got to get above $5 a gallon to start seeing the impact of price on demand.